Good morning, everyone, and welcome. We are delighted to have you join us today. My name is Nicola Korzine, and I am the founding executive director of the NASDAQ Entrepreneurial Center. Now, for those of you who may not know, the NASDAQ Center is a nonprofit dedicated to enabling entrepreneurs around the world to realize their maximum potential and grow. Now, we're going to be opening up live Q&A at the end of this event. So for all of you joining, please submit your questions into the Q&A function at the bottom of your screen, both now and throughout the presentation. And of course, before we get started, just a moment of recognition to the amazing sponsors and supporters who make all of this possible. All of the programming, mentorship, and support that we provide our great entrepreneurs is offered pro bono. We charge for nothing, we take no equity. And we do that all because of their incredible generosity. So to them, thank you for making this possible, for your belief and your support in the amazing work of entrepreneurs worldwide. Now, during these difficult times, we have been launching a few polls at the start of all of our webinars and learn-ins, just to get a sense as to how each of you are doing. So I'm going to go ahead and start those polls right now. The first one that we've been mentoring is sort of understanding how our businesses are faring in this time. We've been tracking this since the start of the pandemic, and we've really been trying to understand how your well-being has been affected. Obviously, understandably, a very challenging time all the way throughout. So if you can just take a moment to share with us, in all honesty, how you are doing right now, that would be tremendously helpful. Thank you. And I'm going to go ahead and end that and share the results. I'm delighted, not surprised, given the topic at hand, that we're skewing towards not just surviving, but being optimistic. Know that all of us are rooting for you on this side too, and for sure hoping to see even more optimism come through in the coming days, weeks, and months. The second one is just for the benefit of all of us today. We'd like to just make sure we get a good read on who's joining us. So if you take just a moment to answer the second poll, are you currently an entrepreneur? Are you aspiring to be an entrepreneur, perhaps a bit of a side hustle entrepreneur right now? Or are you one of the other amazing support systems out there working beside great entrepreneurs day in and day out? If you can take just a moment to share that, that would be incredibly helpful. And I'm going to go ahead and share those results. We have about 50-50 right now joining us on both the entrepreneur level, the other, and a few aspiring, which is always great. And now the last poll that I want to do before we get into the main reason that we're all joining today is just to be able to share our third poll, which is kind of what's keeping you up at night. Now, you should know this poll actually helps us build the programming that you need. So as much as you can share with us what your biggest struggle is in the time, we'll be able to make sure that our content, our curriculum, our webinars, and our mentors are being able to support you. Not surprisingly, in the last month, we've seen an incredible increase around sales and marketing needs by our entrepreneurial community, which now expands over 35,000 wide across pretty much every country out there. So know that you're not alone with these struggles, but they really are greatly appreciated and valued in helping us produce the best content for you in these difficult times. Right now, we're definitely seeing finance, sales, and a little bit of surviving and scale definitely being in the top pain needs. So thank you so much for doing that and for participating in these polls. All right, so the reason that we're all here today to learn beside a tremendous panel of experts on what is going on in the world of venture. And so without any further delay, it's my great delight to give a warm welcome to our guests. We have Craig Sherman joining us today, partner at Wilson Sonsini, Andrew Sparks, counsel at Wilson Sonsini. We have Heather Redman, co-founder and managing partner at Flying Fish Partners, and Urshit Parikh, partner at Mayfield Fund. Please come off of the hiding video, and I'm going to invite each of you, if you will, to give just a very quick background and introduction to you. Again, welcome. Craig, perhaps we can start with you.
Yeah, I'm Craig Sherman. I am a corporate partner at Wilson Sonsini Goodrich & Rosati. Been practicing law for about 32 years, and I'm co-chair of our emerging companies practice group, so very focused on what's happening in the venture community.
Fantastic. Andrew.
Yeah, I'm Andrew Sparks. I'm an of counsel at Wilson Sonsini, and I'm a member of the Emerging Companies Group. I'm normally based in our San Francisco SOMA office, which has a cool co-working and event space. I'd invite folks to check that out once things return to normal. And I help entrepreneurs start and grow technology companies. I've been working with startups for my entire 10-year legal career, and I'm excited to be here today.
Amazing. We're so grateful to have you. Thank you. Heather, over to you.
Thank you. Yes, Heather Redman. I think I've known Craig for most of those 30 years. He likes to remind me that I was one of the first people he met in Seattle, I think, when he came to our fabulous city. I'm coming to you live from my dining room in downtown Seattle, which is a bit bleak at the moment, but we hope for better times. And I am co-founder and managing partner at a firm that is based here in Seattle, investing in seed stage venture, mostly in artificial intelligence and machine learning.
Fantastic. It's great to have you, Heather. Thank you so much. And your seat, over to you.
Good morning, everyone. I'm Urshid Parekh. I'm a partner investing in enterprise infrastructure, healthcare, and engineering biology at Mayfield. I do mainly early stage investing, which is seed and Series A. Mayfield is one of the founding venture capital firms in Silicon Valley, founded in 1969. We've had a chance to back over 500 amazing companies. Over 117 of them went on to becoming public companies. So glad to be here. It's interesting times. I think it's the best of times. It's also the worst of times.
What a perfect statement to probably kick things off for the conversation to follow today, without doubt. For those of you who haven't yet had a chance to read, hot off the presses, obviously the Entrepreneur Report, we have put that link into the chat. We don't want you to leave us today, but definitely make sure you reference it. We're going to be using a lot of the great information to guide us in today's conversation based on really what has been happening. And so on that line, Craig, let's kick things off with you, if you don't mind. You know, inside of the Entrepreneur's Report that has just come out, there actually wasn't that much of a dramatic shift in deals this past quarter. And if anything, there actually appears to be quite a bit of considerable venture dollars that are flowing out there. From your perspective, can you maybe share a little bit about what you think is driving that to be a reality right now, and how this may be similar or perhaps different than some of the other past recessionary periods that we've been through?
Yeah, I think the shock is how different it is. And you can see it in this first chart here that shows the number of up and down rounds by quarter, going back 5 years. And we put together this Entrepreneur Report on a quarterly basis. We pull the data from all the deals that we work on as either company counsel or investor counsel. We aggregate the data and track the data over a long period of time. Unfortunately, I don't have a longer chart, a chart going back longer here, but you can see remarkable consistency in the number of up and down rounds. And for those who aren't familiar with the terminology, a down round is a financing at a lower price per share than a prior round. So back in the happy days of mid-March, or the unhappy days when we first realized that something bad was happening and we were going to have to start working from home instead of going into the office, our partners got together in a room and talked about, well, what should we do and what should we be preparing for? And we started preparing for down rounds. You know, that the last severe recession that had a dramatic impact on the tech industry was really 2000, 2001, 2002, after the dot-com implosion. And companies that wanted to survive, and many companies did not survive that downturn, but for the companies that did survive, they had to raise money at a lower valuation. So we were doing lots of down rounds. As you can see from this chart, over the last 5 years, there haven't been very many down rounds. If we were looking at this chart for 2000, 2001, 2002, we were probably doing more down rounds than up rounds at that point. That most companies that were raising money had to reduce their valuation because of what was happening in the overall market. Now, our expectation in March and April was that was exactly where we were heading, that we were about to relive 2000, 2001, 2002, desperate times, and you know, the orange red line at the top would be going dramatically down, and the blue line representing down rounds would be going dramatically up. And you can see that that is not at all what has happened. And much to our surprise, what has happened over the last 5 months that we've been working from home is remarkably similar to what was happening before we started working from home. You know, the trends going back for 5 years, not just up and down rounds, but generally in the venture market, have been up and to the right. Increasing valuations, increasing amounts of money being raised by venture-backed companies, and a smaller number of deals. So, the trends largely have been towards fewer deals on better terms. And those trends have really continued. If we were looking at all this data without knowing what was happening in the outside world, you would think we were just staying the course. And maybe we can jump to the next slide on valuations. You can see here median pre-money valuations continue to rise and are at record highs. So in seed round deals, the median pre-money valuation was $12 million. If you look back just 5 years ago, the first period on this chart, it was $6 million. So seed valuations have doubled over the last 5 years. I'm working on a transaction right now that is called a Series Seed financing, where the pre-money valuation is $170 million. Now, how that is a pre-money, how that's a seed financing, I don't know. One of the trends here is that terminology has changed, and 10 years ago, seed financing really was a super early stage financing, and the first institutional financing used to be called a Series A financing. But as valuations have increased over time, we've had to change the nomenclature and create this new thing called the Series Seed financing before Series A. But if you look across the board, Series A financing, Series B financings, Series C and later financings, all these numbers are at record highs. And that continues to be the case in the first 2 months of the third quarter. Why don't we jump to the next chart? The median amounts raised in equity financings. In all but the Series C and later financings, we are at record highs as well. So there is a lot of capital flowing. And let's jump to the next chart as well for bridge loans. So the earliest stage financings, the blue bar here is for pre-seed bridge. So this is typically the first money that a company is raising before they raise institutional money, typically from angel investors. You can see the numbers, the median amounts raised are high, and for bridge financings being raised after an institutional financing, so post-Series Seed or post-Series A, sometimes between a Series B and a Series C, you also see the amounts raised are high, not at the record highs, but they're high. So the trends are clear that things are looking pretty good right now. And I think, Nicola, going back to your original question, why is this? I think you just have to look to the public markets. And I think the biggest takeaway from what happened in 2000, 2001, 2002, and what's happening today is that the venture markets really track very, very closely what's happening in the public markets. And part of that is just natural, that it's valuations. We'll hear from our VCs on the panel in a little bit, but I'm sure part of that is driven by LPs feeling pretty good about the world. The limited partners who fund the venture funds, when the public markets are suffering, they typically also have investments in the public markets, and their portfolio will get seriously out of balance if they're too weighted towards venture when the public market sector is declining. And I'm sure that we'll hear from Heather and Rashid that they're hearing from their LPs, life is beautiful, keep investing, keep writing checks.
I love that. I love that sentiment, especially for all of our entrepreneurs and others joining us who were in the optimistic camp. Now, for our poor entrepreneurs who may be wistfully wondering if there's ever $150 million valuation in their future, hang tight. We know that is not the resounding answer for everyone out there. And we do know that this is a very difficult time. Every time is always difficult to raise capital, but certainly in this time, not shying away from that as a reality for many of you who are out there right now. And maybe on that note, Andrew, we could potentially go a little bit deeper into the granularities of industries, because obviously not all industries are created equal when it comes to like who's getting the dollars and who's not. What might you be able to potentially share with us right now around sectors that obviously may be coming into this pandemic in a different environment than others, and where are the dollars flowing at when we look at the industry levels, if you can?
Yeah, so really across industries, what's been interesting to see is a bit of a slowdown in first-time financings. And this is really kind of across industries. What we've seen is VCs getting a little more conservative in some of the instability. And also it's just plain harder to establish that deep bond that's required between a VC and a founder over Zoom. Within sectors, we're seeing a lot of robustness and activity in sectors like telehealth. Biotechnology came in to this period really strong, continues to be very strong. Software continues to be quite strong. Industries that have had a tougher time, obviously, things like travel, hospitality, retail, obviously seeing some dips there, but really kind of across industries again at the later stage, as Craig was kind of getting into the data, things are really quite strong still. We're continuing to see those increasing valuations. We are seeing across industries again exits taking a little bit of a hit this year. I've seen some data that we're on track for kind of the lowest year in a while, but it is interesting to see kind of across industries and then within industries as well. Some are doing quite well. We've got clients in online gaming, for example, that seem to be, going gangbusters. And then other clients, in travel, for example, they're having a tougher time.
Yeah, it definitely makes sense. And, Andrew, I don't know, going a little bit off script here, but we had so many questions that were asking around industries by geography. Are there certain geographies that are true with what you just shared versus others? Anything that you can offer on sort of the scope on both domestic and international funding opportunities right now?
Yeah, so we're continuing to see a lot of health, even internationally. So really across the United States, but Europe, Asia, a lot of health in the market. So things continuing to be really quite strong, and I think surprisingly so as the data is bearing out. And in terms of even within the United States, we've seen over time sort of shifts in how many dollars are flowing into, for example, the Bay Area versus other areas, and continuing to see a lot of strength in the Bay Area and Seattle, other markets continuing to do quite well.
Excellent. That's good news. Thanks, Andrew. Andrew referenced the fact that bonding with investors in this time can be quite difficult. And Mayfield has just done a beautiful job of really being a resource of sharing out information of how entrepreneurs can really prepare in this time, in this pandemic, to be successful. What might be some of the tactical advice that you're offering existing portfolio or those perhaps that will soon be in the portfolio for founders to really weather this storm that we're in right now?
Sure. So, it is, it first starts with acknowledging that it's a unique time. It's a challenging time. And a lot of stress often comes when, the CEO job is a hard job. I've been in that role before. And so can totally empathize sort of with that. And so, I'll start with something that sounds like a cliche and then elaborate a little bit more. But it first starts with really focusing on what is under your control. And ironically, you can actually find amazing opportunities in this market, at any stage of the market. And I can give a handful of examples. But constraints bring focus. And we now have an interestingly extraordinary set of constraints. So, some of our companies like Mammoth and Cuventus, they were really able to use their platforms to create solutions around COVID. Cuventus was able to create a new product that ended up powering a lot of the command centers for hospitals. Mammoth actually has become one of the key sort of new testing technologies. In some cases, because of what happened in March and the amount of money supply that went up, we've had sort of companies actually get into exit opportunities. And so, two other companies I work with, Rancher and CloudGenix, ended up having exceptionally good sort of exits. What is also happening is that there is a lot of capital that is out there, but it is hard for people to invest unless and until they have a higher degree of confidence in you. And a lot of that confidence is coming from when you're seen as a category leader, and what is the data and what is your execution, and do your numbers show that? And so that is an example of something like Mission Bio that ended up doing a big fundraise. Then there are companies who actually got some real impact in healthcare because clinical trials slowed down. And guess what? It gave them the opportunity to start doing remote clinical trials. There are companies that were, in the business of closing enterprise deals, which would typically be millions of dollars in deals at a time. And guess what? People never thought you could do those deals online, but now you are able to sort of do them online. So this kind of starts out with, how do you really think about what is on the not do list, right? How do you see, what are your resources, assets, and how do you sort of vector on that part of it out? And then things that you control are like how frequently you communicate with your team, how you sort of are an empathetic leader, how are you sort of creating a culture of agility, because this is a market which is a whiplash market. Things are doing great right now, and there's a high probability that before the end of the year, we may have a 25% correction, and suddenly, we go from, the panic to bull market back to a panic market. And this leads to the second point, right, which is, startups die because they run out of cash. And so the key ends up being, you can really focus your activities, figure out what your burn is and whether you can get additional capital. There is capital available on the right terms right now. And then acknowledge and recognize that so one thing that I think is a subtext, and I think Craig mentioned in the passing, is a lot of capital is going, but the number of transactions is not necessarily going up. And so capital is accumulating in fewer and fewer companies. So what sets those companies apart? And compared to 10, 15, 20 years ago, I think companies really have to be much more of a movement creator, where they are able to be seen as a category leader much earlier, sometimes in categories which are deep technology or infrastructure. The game is over even before the product's in the market, because you end up essentially getting the best people, the most amount of capital, the best sort of ecosystem partners willing to work with you, things like that. So I think that this construct of, how are you sort of creating a category leader and executing well on it, is where a lot of that capital comes together. And so that is the thing that I think I encourage all entrepreneurs to really sort of think about. So, a lot could be, and each of these things are big things in itself, but there's a high level framework, and then each of the companies can apply to see, what makes sense for them.
Two major takeaways that I'll just continue to iterate, because these are words to live by in good times and tough times for our founders. Controlling the controllable, really hyper focusing in on that element. And then I think really looking at this as a position for rising with innovation in spite of the challenges, and how you're positioning yourself coming out of this time as well. Such great insights, Urshit. Thank you. Andrew, on the not to hyper focus on valuations, but let's face it, we're in a conversation today where valuations are naturally top of mind for a lot of our founders, and for those that are in a fortunate position to be looking at this analysis, saying, "Wow, valuations have actually been steadily rising," and we talked about the public markets obviously being a driving force, perhaps behind some of the reasons why capital is flowing. What about the valuation front? I mean, are there any insights or perspectives that you've been able to look through the data to inform why are some companies getting those kind of influx of increases in valuation? Are they just consistently hitting those markers that investors wanted to see? Are there other factors that are coming into play right now that are driving valuations higher?
Yeah, it's a great question. I think one factor is that VCs are just sitting on a lot of dry powder. So according to some data put out by Goldman Sachs, venture capitalists are sitting on a decade high of dry powder of about $160 billion. And so I think, to your question as well, in a time of some instability, there's been a real focus on kind of quality and strength. And so strong companies are able to raise on increasingly good terms. And in fact, there's a lot of competition for those hot companies. At the same time, you're also seeing that venture capitalists want to protect kind of their biggest and best companies. So they'll continue to invest and keep those valuations up.
Excellent. Excellent. Well, obviously, valuations first start with finding a great investor to join with you in the forces of building an amazing innovation company. And Heather, to turn to you for a moment as a great seed fund that is actively still looking at deals, or at least I should assume actively still looking at deals. Can you walk us through a little bit of how have these times changed, maybe from the due diligence and the nurturing and even that bond building that we heard earlier reflected is harder in a Zoom-driven world that we're all in. What are some of the insights that you can share with our founders who are about to enter that or are in the midst of trying to do that well?
I think it's interesting because, like a lot of the comments today, there's pros and cons of the environment that we're in. I think the cons are obviously that we have a lot less human-to-human social interaction, a lot less social proof through accidental contact. We used to circulate around a lot in the community up and down the West Coast, rubbing shoulders with people, getting input on deals, getting input on founders in a more organic way than we can now. Everything is much more planned, and you don't just run into somebody on Zoom. Although I must say that I've made a habit of showing up for random Zooms when invited. I'm not a Zoom bomber, but I do show up for random Zooms with the sole goal of just chatting on the sidelines. And so for those of you who've been chatted up by me on the, on the sidelines, I'm really just there to chat to you. And that's, my version of going to a cocktail party these days is being there for the chat. So that is less available. And I think that makes that whole bonding process harder and also deal sourcing harder because we rely on that social lubricant to be in the deal flow. However, I think it's also breaking down some barriers. We VCs like to point at the rest of the world and say, oh, that's so funny that you couldn't deposit more than $50,000 a month on your bank, account, or, oh, that's so funny that you couldn't get telemedicine done. But we VCs have our antiquated practices as well, right? So what's interesting in today's world is that we're having to adapt to, and some of the, sort of false barriers around in-person interaction are also falling. So we are doing deals with folks that we have never met, in real life, as we like to say, and we think that's possible. The burden I think it puts on entrepreneurs, however, is that your network and your sort of ability to provide social proof in ways that are not organic becomes even more important. So we are now at Flying Fish much more willing to do deals outside of our geography than we ever have been before, as our brand grows and our focus is on artificial intelligence. So we get inbound now from London and Toronto and other places that we never would organically look for a deal. But we're more willing there if the social proof exists and if we can diligence those deals in a more creative way through our network. And that's, I think, a real opportunity for entrepreneurs. So I would say that's sort of the upside. The reality is, as Andrew alluded, there's a lot of capital out there. So we must invest. And your job is to give us an ability to do that. And so I think the door is very, very open. VCs are not going to sit around for the next 12 months, regardless of vaccine availability, and not do deals. So I would not treat this as a closed window. In fact, I would say VCs are very actively raising capital themselves. The good part about markets being up is that people are optimistic, but also the good part about markets being up is that people don't want to invest more in those markets, right? They're at their peak, or at least one would think. And so there's and with interest rates at record lows and now forecasted to stay there for 5 years, the search for yield and the search for returns is really turning to private equity, in particular to venture, and particularly to technology venture, because if you look at the public markets, again, what's propping them up? Just tech. So I think that on the optimism scale, if I were an entrepreneur right now, particularly at the early stage where I don't have a lot of fixed costs and I'm not locked into a particular business model, I would be super bullish on my fundraising prospects.
Yeah, that's fantastic. I want to ask just a couple of follow-on questions from what you shared there, Heather, if I can. Because of the geographic expansion, or at least openness to geographic expansion in this time, are your syndication partners also changing? Is your own ecosystem changing as a result of looking at different deals? And then subsequent to that, any shifts or changes in the time to close ratio that you were seeing pre-pandemic to now? Are deals taking, just that much longer to diligence because of the environment? Or in fact, because of everybody being in Zoom, are they shortening and shrinking in timeline?
Yeah, as to your first question, I do think there are opportunities there, and it's geographic, but it's also, everything is breaking up right now. Again, to the point of disruption, not just being in the industries that we want to disrupt, but our own industry. We're seeing, some new coalitions form. We're seeing, Black VC, for example. I'm part of a WhatsApp group that's all women founders of VC firms. Still a really small group, but a growing group. And so you're seeing different syndication partners form. Mavron and a bunch of other funds just made this pledge to syndicate their deals to diversely led funds. So I think there's a lot of shifting syndication winds, if you will, but certainly the openness that we have to outside deal flow is also something that's occurring upstream from us. I mean, we, based in Seattle, have always needed to look to the Valley to provide capital to our companies as they get to the later stages. So it's a necessity for us to always be forming relationships with Valley firms. But I do think some of those networks are now becoming broader. With respect to deal time, I would say it is a bit slower. Partly we're in the summer doldrums. We are expecting a tsunami of deals in the fall. If you look at the Y Combinator data, if you look at the Patent and Trademark Office data, if you look at what happens traditionally with the vesting cycles of the big companies, Amazon and Microsoft, which of course are in my backyard, so I'm intimately familiar with them. They all have big vests right around September. And so the traditional bail out of my big company with my nice fat stock option package season is upon us. And so, we are expecting a ton of deal flow in the fall. And so I'm expecting to have to turn things around very quickly, because I think there will be some deals that are sort of must-dos. And that's really what drives VC velocity. It's not Zoom. It's like, how competitive is the environment and how good are the deals?
Well, speaking of macroeconomic trends like the ones that Heather just shared, Urshid, maybe I can invite you, leaning a little bit more even to that sentiment. What is this time period enabling entrepreneurs to learn from both the macroeconomic trends that are out there, and hopefully even maybe take advantage a little bit of those in their favor as we come out of this scenario?
Sorry about that. I think there's a lot of great. So if I was to put the short, medium, and long term view, I'm actually very, very bullish. And the reason is I'm not saying things are going to be easy, but I'm very bullish because what happened in March is that the federal government fundamentally changed a basic tenet of all the economic theory that we had learned, which was that capital is actually the constraint. By effectively doubling the money supply in a month, if you are holding on to cash, your cash is probably worth half as much. And the biggest bottleneck now is human capital that can actually innovate with it. And this is where and so there is a phenomenal appetite at this point in time to innovate across industries in all kinds of transformation. We do early stage investing, and some of our early stage investments in what are very capital intensive areas are raising phenomenal follow-on rounds right now. This includes semiconductors, it includes synthetic biology, it includes deep tech infrastructure. And so there is huge appetite for people to want to invest in innovation that is actually going to just make our lives better. At a very personal level, I've decided to focus, and Mayfield has been basically one of the leaders in the notion of conscious venture capital. And if you go to our website, you see a blog which talks about sort of the 5 pillars out on that end. But I look at like the big challenges that we are facing with regards to social challenges or human or planetary health. And we think that they are some of the biggest entrepreneurial opportunities of all time. I think on the social side, our investment team has been the rise of the individual. And it is much more about not AI to replace, but it's intelligent augmentation that enables and empowers. And there's a reason why it's a good business, because you really are going to create champions who want to buy your product and become superhuman with your product. So I think on the human health side, COVID kind of gives us, as you said, right, biotech. And then on the planetary health side of the house, right, this then takes the transformation beyond just tech and healthcare into food, materials, just all energy, all the sectors sort of out of the economy. So that's kind of the longer term view. And now how do we get from here to there, right? And so I think the first is it's a phenomenal time for funding and M&A because as you've seen, the tech companies have been less impacted, and because the money supply went up, the tech stocks have gone up a lot. The revenues haven't, right? Barring a few like Amazon, for most, the revenues haven't gone up. And so the public company multiples have expanded quite significantly. What that has done is it has done two things. First, even private companies who are growing faster, were not raising at those multiples. So it is actually really becoming a whole, and so if you are a company that's outperforming, you are going to get phenomenal valuations, and you are getting phenomenal valuations. And in fact, there is such a stampede among VCs for the best companies. One of the companies I worked with saw a round of $50 million go from term sheet to close within 3 days. I've never seen that even in normal times.
My goodness.
Yeah. So there is that attribute. The second is it has actually made a lot of the large companies much more open to paying huge premiums to acquire smaller companies as well. Because normally what happens is, if you are a public company, you're trading on multiples, say 15 times your earnings, or maybe, 5 times revenue. Right now, you're probably trading at 30 times earnings, and suddenly it makes it much more viable for you to, acquire companies. And so if companies are executing and are finding that their business is tracking very well and they can continue on the path to IPO, they are doing that. But then if companies are seeing that they may end up having some cloudy weather, there's actually turning out to be an interesting intersection of sort of buyers and sellers, right? I think then for companies that are, executing right now, the next question really on the macro side is how well the business will be a year from now, if you have to go raise a year from now. We can say with a high degree of confidence that the medical or the health effects of COVID will probably be behind us in a year. Be it treatments, be it vaccines, or just growing population immunity, all of those factors will sort of get there. But, in the past, you've never had to worry about stuff. Now you do, right? You do actually have to think about what are the directions on the elections. And I could argue on both sides, right? I could say that doesn't matter who wins if, the current administration's printed so much capital. And if the government changes, they'll print even more capital. And so we should be in a great market, right? And then on the other hand, if the new administration that comes in, which is not the same one, your long-term capital gains tax go from, if you're in California, 37% to 60%, it really creates a strong reason for people to sell a lot of the stocks that they own to take profits out, at this tax rate, because, especially on money they'll need in the next 5-7 years, and that can kind of suddenly become a stampede of sorts and can change the dynamic out. I think the key on that ends up being that, you just have to sort of execute to becoming the best in your category. And that's, it sort of keeps on, and you see that as a theme that kind of coming back over and over again. And so I think be prepared for whiplashes, that'll come from the macro side. I think we have a lot of, liquidity in the system that will provide a great buffer, but I'm not so sure there is enough slack in the system to deal with another big shock, right? If, Craig referred to the 2000 to 2002 sort of time frame. If you see how the public stock markets are trading right now, they look a lot like, late 2000, early 2001, and then 9/11 happened. And so in terms of the forward, you had the first shock, the dot-com bust, you had a lot of the financial sort of liquidity come in from the central banks. And that sort of propped up the market for a while, almost coming back to the previous peak as has happened. And then a second shock comes to the system. And, you know, I'm not saying there will be one, but I'm definitely asking entrepreneurs to ensure that, you know, while they, you know, not to get sort of stunned if one happens, and just continue to execute.
Great advice. Truly great advice. You know, Andrew, we've talked a lot at sort of the higher levels of things being really good. One of the amazing things that I always glean into from the Entrepreneur's Report is also understanding some of the specific terms that may shift from one dynamic to another. In this last report, were there any unique deal terms that surfaced that were, you know, interesting to share with this audience, or any that you were expecting to see and maybe that aren't surfacing right now?
Yeah, I think one of the biggest things, and Craig alluded to this earlier, was we expected to see a lot of down round and pay to play transactions. We were really bracing for that, but we just haven't really seen it so much so far. You know, we saw a slight uptick in pay to plays, and you'll see that in the data. It was something like around 3% of deals in 2019, up to 8% of deals in the first half of 2020. So there was a slight increase there, but really not kind of the movement that we thought we might see. Something that we have seen that's a more nuanced term a little bit more is we've seen more tranched closings. And this is where investors give some money up front, and then they give more money later on upon the completion of certain milestones. Maybe that's hitting a certain revenue metrics, getting a key commercial agreement signed up, things like that. So we have seen some of that type of activity. We've also seen investors at times pushing for more aggressive liquidation preference multiples or participating preferred, which means that in a sale, they get their money back first, and then they get to share pro rata in the sale proceeds. But overall, we really haven't seen much of a change in those terms either. So it's a lot of kind of staying the course so far.
That's positive, really positive. You know, Craig, one of the sources that we haven't really spent too much time talking about, and yet even inside of the Center's Milestone Maker program, we've had a few of these examples in the last couple of months of corporate venture really coming to the table in pretty big, meaningful ways. What are you seeing right now on the CVC front around both the amount of dollars that are flowing in, any shifts or changes that have been noted from that specific type of investor base right now?
Yeah, we definitely saw a slowdown in corporate venture activity, and that's to be expected. The corporate VCs typically are the last ones to start investing near the peak of a market, and you may be able to correlate corporate venture activity with market peaks fairly closely, and they tend to slow down more quickly when markets decline. But now that the market is steady, we're seeing the level of activity begin to increase again, and we're seeing corporate VCs quite active once again.
Very cool. So I have a couple more questions. And again, just as a reminder, for those of you who haven't yet had a chance, please pop your questions into that Q&A box. We're going to try to get as many of those as possible into our remaining time here just in a couple of minutes. So with the last couple of questions that we got surfacing, I really want to come back to a little bit of sentiment on, okay, let's get predicting into the rest of this year. We've spent a lot of time looking at things that have pleasantly not surprised us. We're all bullish, I think, on this call as to what's to come. Are there any signals that you guys are specifically looking at in the market, and this is open to all of you, that you think are going to be really critical to sustain this current investment activity? Again, I'm assuming November is going to be one of those out there, but it sounds like even in that landscape, maybe not as much as we might worry about. Any other signals that you guys are looking at, inflections with COVID rates, anything else that is driving consistent concern or worry, or what's keeping you up at night right
now? I would say what has been proven in the early 2000s and 2008 and proven yet again now is how closely tied the venture market is to the public markets. And so I think that's the best indicator of the level of venture activity and valuations and all the other things that we've been talking about today, is how the public markets fare. And if the public markets continue to hold up with these record high multiples, then I think venture is going to hold up. If there's a correction, I suspect that a correction in the venture market will quickly follow.
Yeah, and I think Urshit put his finger on it. I think, you know, the biggest risk right now is that we have so much instability in a number of different, you know, sort of sectors in the world, you know, geopolitical, climate. So we could have another major exogenous factor to the business that we're all in. And that's probably the biggest risk. If we're just dealing with what we're dealing with right now, by which I do include the election risk and all the other social issues that we've got going on, I think we continue much as we are today. But if there is something, you know, truly cataclysmic, it's supposed to be a meteor, you know, that almost might hit the earth, you know, right before the November election or so, you know, there's some crazy stuff out there. But other than that, I think we're steady as she goes, with a bumpy ride, you know, steady taking the semi-medium term view, but bumps along the way.
Excellent. Rashid, yes, please.
No. I mean, I already touched upon this, so I won't add much more. I do think that you know, we have a complacency that is setting in at all levels not on Main Street, right? You started seeing the layoffs starting to come in, some big numbers beginning to show up. It was great that we had, you know, the federal sort of you know, direct payments to consumers, right? And I think that'll become a best practice for going recessions, especially in the US, since you can print more dollars more easily. But that effectively held up consumer spending. But the one thing I do worry about is just political complacency, because I think everything's great. You know, this thing didn't kill us, and then you know, we actually let a Lehman-like moment happen, and suddenly everything freezes up, right? Fundamentally, fear and, you know, a lot of fear, and when trust disappears from the markets is when sort of the biggest challenges happen. And so that to me is there is the big exogenous factor, and then there is the complacency which just lets a train wreck happen.
Here's to no train wrecks as much as possible, huh? All right, so what we want to do before I open it up to Q&A is we always ask for this, every amazing panel, to give us one key takeaway, actionable key takeaway, that our entrepreneurs who are currently fundraising or entering into this mode can apply to help them in this time, whether that's, you know, tactical things that you suggest dealing with virtual diligence for our amazing investors on the call, or how to build up one or two new relationships that they might have. For Craig and Andrew, anything on the legal and insight side of the house, give us some of your best sage actionable advice before we go into Q&A from our audience here today. Whoever wants to start. I won't pick on you, I promise.
Maybe I'll jump in first. I would say, and this isn't really legal, it's this business, being an early stage entrepreneur and working with VCs is all about relationships. And I think before you take money from an investor, you know, the investor is going to do diligence on you. You do your diligence on that investor and make sure that you're going to work well with that investor, because as we've been talking about, times are surprisingly good in the venture world for the moment. That will not last. There will be a downturn at some point, and whether you're going to be successful or not long-term in your business is going to be very dependent on how strong and steady your relationship is with your investor.
Very true. Who's next?
Heather?
Excellent.
Sure, I'll go. One thing we've been seeing come up a lot, and I'll be interested to see whether people are feeling this or not, is that I want to take advantage of COVID. I want to pitch my COVID kind of strategy, but I also don't want to be short-termist because COVID may be gone, you know, we hope, knock on wood, in a year. And so, you know, there's a ton of disruption going on. You know, there's obviously a recession, there's COVID, there's work from home that's as a result of COVID. Barriers are falling down all over the place. And so the temptation is to build a go-to-market or build a strategy around those disruptions. And I think what's really important is to think kind of medium term and be able to explain your strategy in terms of how the COVID disruption is going to allow you to create a new category, productivity software, ed tech, whatever it is, healthcare, et cetera, but be sure it's not too tied to the COVID moment. And so spend a lot of time crafting that message, because I'm seeing a lot of companies trip up on either being too short-term or too long-term in that respect.
Really, really insightful. Thank you, Heather.
So I first will start with both completely supporting what Craig and Heather have said. And I think this is in the spirit of how do you do build to last companies. And I think it fundamentally does come down to the culture, and the founder and CEOs live the culture, right? And what are the things that you need to really be a build to last kind of company that, so you do need the agility, you do need empathy as a leader, you need resilience, you need intellectual honesty, right? The common tendency for people is you're getting feedback or criticism is to go on the defensive, versus it's, important to recognize for most people, it's actually pretty easy to not give feedback, just nod and smile. Especially in a woke era where we are, people are much more likely to get in trouble for giving you feedback. So if they see you clam up or go on the defensive, and they can't even do a face-to-face meeting with you, and they're talking on Zoom, it's just easier to, call the meeting to a call. So I think that intellectual honesty is key, because if you have that, you're able to then work through, get the signals, right? Most CEOs will find all missed opportunities, and all company-making moments often have some breadcrumbs. And if you were just, aware enough to kind of seize the moment. So I think that's a big one. And then I said, right, I have this culture of innovation, but one process for it is to have constraints, and constraints bring focus and sort of create a not-do list. So I think these are as tough as the times as it may be, right? I think, probably the single biggest factor that determines whether a company succeeds or fails is actually the founding team, their actions, and the culture. And so that's, I believe entrepreneurs change the world. And I love championing the cause in the process, and want more and more of those to be successful, because the existing big, large companies, they're not the ones who are going to go fix the world.
Hear, hear.
Yeah, that's great advice. I think what I would say is, and I know we have a lot of entrepreneurs in the audience today, and I think if you're thinking about raising money, don't wait is kind of what I would say. It can often take a lot of time to raise capital, often something like 6 to 9 months, even in sort of a normal economic climate. And so you don't want to start, raising money once you've gone sort of too far and the gas tank is almost empty and you start to look like a distressed asset. You want to try to raise from a position of strength, and you don't want to kind of wait until the end of the day to go out and raise. And what we're seeing in the market data that we've been highlighting here is, there's still a lot of deals continue to be done, a lot of capital flowing. So go out there.
Go for it. I like that. All right. I'm going to do some rapid fire questions. We're going to see how many we can get to. And again, thank you guys so much. Such words of wisdom that are true, not just today, but for the marathon of entrepreneurship that all of our great leaders joining us today are on. First and foremost, 409A evaluations. Quite a few questions actually that have been coming in. Is now a time that we should be going down that proverbial rabbit hole of redoing our 409A evals? Any thinking on pros or cons to that question that is coming up?
Yeah, I think in March, when people thought that valuations were going to decline, a lot of companies said, well, I just did my last 409A valuation in January, and in theory, I can rely on this for pricing my options for a year, but the market's declining. So I know of a number of companies that did go out and got a revised downward valuation at the end of April, or in the middle of April. And we actually did a number of option repricings for private companies based on updated valuations. But again, the private company valuations tend to track the public markets quickly. The public markets are back at record levels. So unless you're in a sector that's been heavily affected, or your business has been heavily impacted by the pandemic or by other factors, I think it's less likely today that you're going to be able to take advantage of of what's happening in the world to lower your auction pricing.
Great thoughts. Thank you so much, Craig. A similar tactical question, or maybe a curious one about future state. The new SEC rule that's been opening up some investor categories. Any thought as to whether or not that's going to help more flow of capital out in the markets right now, shifting flows of capital? Anyone want to kind of comment and maybe even share for those that may not know what these new categories are that are emerging?
I mean, I could give a higher level sort of view. I think we see this every time, the stock market's hit an all-time high. Everyone's an investor, and then everyone starts becoming a VC. Venture investing shouldn't basically be as cyclical. It's a much longer term business, but investing is such an emotional business. It's so much about how people feel that, to Craig's point, if you're going to build a company, it takes, 7-10 years to build a really great company, right? And you don't want people coming with panic, people whose funds may not be around. I mean, all of those other things like that. So it's important to be mindful for that. And sort of doing the diligence on that side of the house. So that to me, that is the fact where I think we will have more and more capital coming in, because you have the sovereign wealth funds, the pension funds, just people, who need to actually pay out, so they will only do so by taking on more risk. But what will happen is if a new fund starts, invests, doesn't do as well in 3, 4, 5 years, right? That it's that kind of churn that you also have to be, mindful of.
Yeah, I keep coming back to the words of wisdom that have been shared throughout this conversation today. Find value-aligned investors that are with you for the long term, not just for the moment. And on that note, there's been some very understandable concern of like, how do I not bomb it? I want to be the kind of, intellectually honest entrepreneur that Urshit wants to fund. I want Heather to be inspired to invest in me wherever I may be in the world. But what are some of the follow-ups or worries that you've seen around pitching right now that is working or not working when companies are coming in trying to connect with you in this time? Any tactical things, again, timing of like plan on half an hour, really make it more of a dialogue? How do you encourage people to really navigate the pitching aspect of connecting with you in this first meeting or second meeting time zone?
Heather, do you want to go first?
Sure. I would say authenticity is more important now than ever before because you're not getting all the body language. So there's so much less signal to read. So the ones I have seen fall the flattest have been the ones that are very rehearsed. I don't think you can probably get it done in a half an hour. I think, maybe a quick screening just to see if it's sort of a thesis fit, but not in terms of really understanding somebody's business well enough to evaluate. I would plan on more like an hour. And I think if you can send a deck in advance, but then have a pretty informal flip through some slides so that you have some structure, but not have it be rehearsed, has got to be your best approach. A lot of us are really addicted to slides, so it's hard for us to focus unless there are slides. So I would not dispense with the slides altogether. And then I would be sure to follow up with the deck as well. And just, I think it's an underappreciated resource, but you've got to continue to update investors. So even if somebody said no, ask them if you can put them on your investor list and then give them regular updates, because that's how you build that community around you and start getting those referrals as well.
Excellent. Rashid, anything you'd add there in our final moments together today?
I mean, I can add a few things, but I actually fully agree with everything that Heather said. And I'll basically say that I think you just have to adapt your communication out to the new media. And then, it kind of comes down to the size of the checks that people are writing. If you're writing big checks before the company has done much, then, I'm actually choosing to meet with people in a socially distant manner as I'm making investments. For smaller seed checks, doesn't matter as much. mid or late stage companies where there's lots of data and tons of social proof, you don't need the meetings out on that.
Yeah. Well, guys, I can't even begin to thank you so much for the time, the insights, the care, the attention that you've all provided today. I hope if you'll indulge maybe another opportunity before the end of the year to bring us all back together and talk about what we've learned over the next 6 months that are to come. I'm sure it will be voluminous to say the least. And I know all of our entrepreneurial community and beyond would so greatly appreciate continuing to learn from you. Again, thank you so much. It has truly been an absolute pleasure. And we will be following up and continuing to track this over time. So for our entrepreneurs and others joining us today, stay tuned, more to follow on this. If you haven't yet read that report, make sure you do so. A wealth of knowledge above and beyond everything that our amazing panel covered today. And again, please take a moment, if you will, as our request back to you, tell us what more you need from us in this time. There's a survey link that's been dropped into the chat box. If you can take a moment to complete that when you get a chance, we'd really appreciate it. Not just for the feedback on this panel, but again, what more we can be doing for you who are doing so much for us in this time and beyond. Stay tuned, more to follow on upcoming events, and we will look forward to seeing you all again very soon. Have a wonderful day, and thanks for joining.
Thank you. Bye-bye.
Thanks, everyone.